Your insurance agent is a nice person. They came to your wedding. They remember your kids' names. They reply to your WhatsApp at 11 p.m. faster than your own family. So this video is not about attacking them. But I need to ask one honest question. Why does your insurance agent drive a nicer car than you? The answer isn't that they cheated you. It's that the whole system is built to reward them for selling you the wrong thing. Today, I'll show you exactly how and what you should buy instead. First, you need to understand there are basically two ways to buy life insurance, and they are wildly different. The first is term insurance. It's pure protection. You pay a small amount, and if you die during the covered period, your family gets a big payout. That's it. No savings, no investment. Cheap and simple. The second is an investment-linked policy, ILP for short. This one bundles your insurance together with an investment account. One premium, two jobs. It sounds smarter. It sounds like your money is working harder. Hold that thought. In Malaysia, ILPs are the dominant product. They make up around 60% of the life insurance business. And there's a very specific reason your agent loves selling them. Here's the part nobody explains to you. When you buy insurance in Malaysia, your agent earns a commission. That's normal. Everyone who sells things earns something. But look at how it's structured. On a regular life policy, the agent can earn up to 40% of your first year's premium, just in year one. Then it keeps paying out for 6 years. Added up, the total commission can reach around 125% of 1 year's premium. Now, here's the kicker. For investment-linked policies, back in 2019, Bank Negara removed the commission cap entirely. So on an ILP, there's no fixed legal ceiling on what your agent can earn, so put yourself in the agent's shoes. You can sell a cheap term policy and earn a small commission, or sell an expensive ILP and earn a much bigger one. Which would you push? This isn't evil, it's just human. Show me the incentive, and I'll show you the behavior. And it's not just commission. Sell enough, and there are bonuses, awards, and fully paid overseas trips. There's a whole club called MDRT that celebrates the top sellers. That holiday photo your agent posted from Japan, you might have helped pay for it. None of this is illegal. It's all disclosed. But it all points the same direction. Sell more, sell bigger. Okay, but maybe the ILP is still good for you, right? 2 jobs in one. Let's open it up and see what actually happens inside. Every month, your premium gets split. Part pays for your actual insurance, part goes into investment. But in the early years, a big chunk also gets eaten by fees and charges. In the first 3 years, only about 60% of your money actually gets invested. Now here's the part that shocks people. The cost of your insurance inside the ILP is not fixed. It rises as you get older. When you're young, it's cheap, so lots of your money gets invested. But as you age, that insurance cost climbs higher and higher. Eventually, the insurance cost gets so high that it starts eating your investment savings to pay for itself. Your own accumulated money gets quietly drained to keep the policy alive. And in the worst cases, decades in, the savings run dry completely. The policy collapses. People who paid every single premium for 30 years suddenly find that coverage has lapsed, right when they're old and need it most. This exact problem is why Bank Negara had to step in with new rules. So let's talk real numbers. Say you're a healthy 30-year-old. You want 500,000 ringgit of coverage, so your family is safe if something happens to you. With term insurance, that coverage costs you roughly 50 ringgit to 100 ringgit a month. With an ILP giving you similar real protection, you're often paying 200 ringgit to 300 ringgit a month or more. Same family protected. Very different price. So what smart money people do is simple. They call it buy term and invest the difference. Buy the cheap term insurance for protection. Then take the 150 ringgit you save every month and invest it yourself in EPF, ASB, or a low-cost fund. This way, your protection and your investment are separate. You control the investment. No hidden insurance costs creeping up to eat it. And if you want to stop investing for a while, your insurance doesn't collapse. And let me show you why this matters so much with real numbers. That 150 ringgit you save every month by choosing term over an ILP. Don't just spend it on copy, invest it. Put that 150 ringgit a month into something earning around 5% like EPF and leave it alone. After 30 years, that little difference has quietly grown into over 120,000 ringgit. That's not a typo. The gap between term and ILP invested over your working life is worth more than 100,000 ringgit. So somewhere out there, your ILP bought someone a very nice car. It just wasn't you. Now there's one more thing you actually do need. And it's not the ILP. It's a medical card. This pays your hospital bills. And in Malaysia, that matters more than ever. Because medical costs in Malaysia are exploding. Medical inflation hit about 15% in 2024. And it's heading towards 16% in 2026. That's one of the highest rates in the whole region. A single hospital stay can wipe out years of savings. But here's the trap. Most medical cards are sold as a rider stuck onto an ILP. So when medical costs rise and your premium jumps, it drains that same investment pot even faster. Recently, some Malaysians saw their medical premiums jump so much that Bank Negara had to step in and force the increases to be spread out. Now let me be fair, because this matters. Insurance itself is essential. If you have people who depend on your income, you absolutely need coverage. And a good agent is genuinely valuable, especially when it's time to make a claim and you need someone in your corner. The problem isn't agents, it's the incentive system that quietly pushes even good people towards selling you the expensive product. So your job is simple. Know the difference before you walk into that meeting. An informed customer can't be steered. So here's your simple plan. 1. Buy cheap term insurance for protection. Enough to cover your family, around 10 times your yearly income. 2. Get a proper medical card, ideally a standalone one, not bolted onto an investment. 3. Invest the difference yourself in EPF, ASB, or low-cost funds. Keep protection and investment separate. Do that, and you'll be better protected than most people for a fraction of the price. And maybe, just maybe, one day you'll be the one driving the nicer car. If this opened your eyes, share it with someone about to sign a policy they don't understand. That's your Ringgit Explained. See you in the next one.